Hi, thank you for tuning in. Welcome to the It's Your Money and It's Your Estate workshop series brought to you by our nonprofit organization, Financial and Estate Literacy. Our mission is to empower people like you to take control of their finances, their estate, and charitable giving decisions. For the past 25 years, our founder, Peter Coate, and our entire team have been providing these free, unbiased, and accessible 6 weeks programs all over Orange County, California to help you make informed choices that align with your unique needs and values. Now let's start the program. This webinar is the 5th session of the It's Your Money program. The topic is equity and fixed income investing. Our guest speaker is Mark Hebner. Our moderator is Peter Coate, and this webinar is brought to you by Providence Mission Hospital Foundation. Enjoy the workshop.
We'd like to step forward into a deep dive into equities and fixed income, and today's presenter is Mark Hebner of IFA. Welcome, Mark.
Thank you, Richard. Those were all really good points you just laid out there.
Well, thank you. Thank you. So, Mark, why don't you tell us a little bit about yourself? We're going to go over the Ask First form. So I guess I'll start off with education. Why don't you tell us where you're educated and how that went?
So I'm a nuclear pharmacist by my first education. Then I went to get my master's in business and administration, my MBA here at UCI. And I started IFA 25 years ago. I'm a Series 65 registered investment advisor representative.
And tell us a little bit about Series 65. What does that mean?
So Series 65 is I would call it a basic test about understanding the regulations and the rules and investing principles that allow an individual to represent a registered investment advisor.
Fantastic. And then you do serve as a fiduciary. So at all times you'd be a fiduciary to your clients.
That's right.
And tell us a little bit, how are you paid, or how is IFA paid from the client?
So IFA is only paid by the client, which aligns our interests with the client. That was one point I'd add to what you were saying, because we're basically on their side and representing them in this really complicated world of capital markets, which I hope to simplify for everybody today. But we're a fee-only firm, and so we only charge as a percentage of a client's assets, and we do that 4 times a year. So we take their annual fee and divide it by 4.
Fantastic. And give us an example. Is it let's say $1 million of assets under management? What would be the fee for that?
So $1 million, I believe, is around 0.7%, something like that.
Okay, fantastic.
And then look it up. It starts at 0.9 for $500,000.
Okay, and then I was going to say the minimum, is your minimum roughly about $500,000?
No, our minimum is 100,000 actually.
Oh, fantastic. Okay, very good. And you're not a lawyer, so you don't do any legal services.
Nope.
And then on your Ask First, we noticed we have your contact information there as well. Does IFA, for our students, would you provide a consultation for anyone that wanted to come on in and see how their asset allocation is doing or how their finances are going?
Yes, I'd be happy to do that. And Neil Rudder is also on the list of attendees today. He's our investment advisor rep who works with Pete and It's Your Money team. And so Neil would be a great contact for any of the individuals who are interested in talking to somebody, but I'd be also happy to sit down with anybody and explain this.
Yeah, absolutely. I've known Neil for a long time as well, and he's a great guy. Well, very good. Well, Mark, welcome to the program, and
Thank you.
Let's get started with your presentation.
Excellent. I am going to share my screen so we can get started here. All right. Well, first of all, thank you for joining us this morning and taking a little journey to improve your understanding of equities and fixed income, basically stocks and bonds and investing. And we're also going to touch on the concept of passive investing versus active investing in my presentation. Now, I have a lot of slides here. You will be getting copies of those slides, as far as I know, and we typically don't go through every slide in detail because there's so much information. And so I might skip around a little bit, jump over some concepts or some of the text. And so there is a question and answer button for you if you look at the bottom of your screen, and you are welcome. I see maybe it's a chat button. You're welcome to enter questions if you have them, and I will do my best to answer them before we leave. Okay, so here's a quick little bio on me. I gave you some quick information. I'm also an author of a book called Index Funds, the 12-Step Recovery Program for Active Investors. And that's a little hint that there's some addictive nature to gambling in the market, which most investors tend to do with their money or pay somebody else to gamble with their money. I just published the 20th anniversary, 10th edition of that book, partially because it includes a lot of information about returns of markets, and we have to update that data for our compliance reasons. And so every 2 or 3 years, we tend to republish it and get a new edition out. This is a quick little summary of our firm. We have over 2,400 clients. As of September 30, we manage $5.5 billion in assets. That puts us among the largest registered investment advisors in the country. I think we just ranked number 83 on the CNBC ranking, which is not based on AUM. They have a whole bunch of different criteria there. But we are a substantial firm across the country providing wealth management and tax services. Now, here's a list of all of our fiduciary services, as well as some of the referrals that we offer to clients. And if you do a quick scan of those, you'll see it's quite comprehensive. And that's what we almost need to do with $5.5 billion in assets and a wide range of clients, ranging from clients in excess of 100 million to clients as low as 100,000. So there's wealth management. We do tax returns, financial planning, retirement planning, help clients set up pledged asset lines, college planning, Social Security optimization, charitable giving. That was my friend Cynthia Campos, and that is one of the things we do. I was also the chair of the Mission Hospital Foundation for the previous 2 years, so I'm quite active in that charity. And I would urge all of you, especially if you're in the Mission Hospital area, to consider donations to that wonderful organization. We also can analyze your estate plans, but we really prefer to send you to an estate planning attorney. So you see under the referral services there, we have hundreds of estate planning attorneys across the country that we provide referrals. We have a nice little website where you can put in your state, click the drop down, and get a number of names. On the insurance side, Richard had mentioned how insurance agents are paid by commissions, and a lot of commissions, I must say. But we recommend that clients meet with basically a fee-only insurance advisor. There aren't many of those across the country because most of them want to sell insurance, and he actually charges by the hour, is not associated with any insurance product, and can help you in a similar manner in the way we help you. He acts as a fiduciary for clients and does a great job. All right, I'm going to move on real quick. Clients hire IFA to do these things. Number one, to be your fiduciary. What is that? Well, that basically says we are required to act in your best interest even if it goes against our interest. And I like that last part because there's a lot of conflicts out there for firms. And in fact, when we provide you our summary of our firm, the client, what's it called? A company summary report or something like that. We do make the disclosure that even though we're your fiduciary, we would like to get more assets. And so in that respect, I guess we have a little conflict and that we're still selling you to become a client. I like to think of educating you to become a client. So we select and monitor various investments, index funds, ETFs. And by the way, that term index funds has become quite complicated lately. The SEC actually shows two different types of index funds in their bullets. One that are traditional index funds based on more traditional indexes that you might have heard about or seen on the web or in a paper. And then there are non-traditional index funds that are focused on factors such as small companies and large companies. And that's kind of the area that we like to research and help clients figure out how to invest their assets in what we call non-traditional index funds. So we construct portfolios designed to maximize your expected return. Expected in there is a very important word because that really means the middle of a future distribution of returns. Returns on a monthly basis anyway look a lot like a bell curve, and expected refers to the center of that bell curve. And what makes investing so hard is most of the returns are not in the center. We call those unexpected returns, and clients mostly get unexpected returns, and that makes investing eternally confusing. So we integrate your existing holdings into your portfolio sometimes. Sometimes we separate them out if you have a lot of capital gains. And so that's more important for those who become clients. We consult on tax efficiency, retirement planning services. We do that as well. Recommend estate services, offer 401k recommendations, and we manage 401k plans. We also do that for Catholic institutions, their retirement plans. And we review your overall financial picture, including non-managed assets, and we do that through our two individuals that do financial planning for clients.
Mark, really quick, back on that slide, up on the top point there, I want to just reiterate on being a fiduciary and like a scenario where a client says, hey, should I pay off my mortgage to try and free up some cash flow? That's going to decrease the amount of assets that are under management. But if you pencil out the numbers, and it might make sense that it's better to pay off that mortgage, that would be a true fiduciary, would be telling you, yes, let's pay off this mortgage, free up the cash flow, even though the advisor would be making less money. And that's kind of a good example of
I like that example. I like that example, and we're asked that question all the time. Oftentimes, the factors I'll consider are what interest rate you're paying on that mortgage. If you got a 2.5% interest rate you got a while back, probably should hang on to that. As clients get elderly and they've got a lot of other assets, investments, I like to have them pay off that mortgage. And so one of the nice things about having $5.5 billion is those decisions become less important when they have less impact on the overall assets that we're managing. And so I think that's just another good reason to work with firms that have larger assets is these decisions aren't as important. If you imagine if you're working with a registered investment advisor who has, I don't know, 100 million or 200 million under management, and he tells you to pay off a $2 million mortgage, that has an impact on their income. So anyway, that's a good point, Richard. Thank you for bringing that up. Anything else you want on this slide?
No, it's looking great. Let's continue.
All right, good.
Thanks, Mark.
All right, so Pete Coate asked me to talk about some of the basic elements of stocks and bonds. I'm not sure what the level of familiarity of each one of you are with those. And so I'm going to be careful not to make it too simple. And if somebody has questions, you can ask them. But before we get into that, and while you're still relatively fresh, I'm going to hit you with what I believe to be the most important concepts for investors. And both of those were components of Eugene Fama's Nobel Prize he won in 2013. And he basically won a Nobel Prize for two really important ideas. And if you have a pen and paper, I would love to see you write those down. The first one is summarized as prices are right. Well, what's that mean? What that means is that prices basically include or reflect all the available information that some 10 million traders know at pretty much any moment in time. There's roughly 10 million traders trading every day, and they trade about 10 billion shares a day on some 44 stock exchanges around the world. And so the likelihood that we have mispriced securities is very, very low. And yet, almost every time you hear a so-called investment expert, they're focusing on whether a security is overvalued or undervalued, and that's how they make their decisions as to what they want you to invest your money in, or they advise you to invest your money in. However, Eugene Fama won a Nobel Prize for this first idea that prices are right. They're fair prices. Fair is a statistical term, really, and you should think of it as a fair coin or fair dice. That basically means the next event is not sort of leaned, it's not directed in one direction or the other. And so on a daily basis for securities, because they're fairly priced, the next day there's an equal chance, or literally the next hour might be better, there's an equal chance that it will go up or down. That is considered fair. So this is so important for investors because everybody kind of looks at the news, looks at TV, listens to some expert, and they think, oh my gosh, the market or some price of some security is too high, it's too low, and therefore, I'm going to buy or I'm going to sell. All of that is nonsense. And just remember that Eugene Fama earned a Nobel Prize for this very idea. The second thing that's really important, and you can write this one down as well. Number one, prices are right. Number two, risk and return are related. So risk is really the explanation of the returns that investors earn. So what is the function of all these stock exchanges around the world, trading these 10 billion shares every day? Well, the reason we have exchanges is to discover and to set fair prices for these securities. The price needs to be fair for both the seller and the buyer. And what's really going on sort of underneath the surface there is the seller is determining their cost of getting this cash from you, from the buyer, really, if you're the buyer. And so we call that the cost of capital. And so if they were to sell a stock and then over the next year it went up 10%, well, that was their cost to get that cash. They gave up that 10% return. So we call this the cost of capital of the firm or of the seller. And it matches the expected return of the investor. This was actually another Nobel Prize for that this cost of capital equals the expected return for investors of a gentleman named Merton Miller. But it's really important you understand that, and it's what drives these prices to be fair is you have these equal and opposite forces of sellers not wanting to give up too much return, not have too high cost of capital, and buyers not wanting to buy at a price that positions them to get too low of return, right? So it's this battle of market forces that drive all prices to being fair.
So kind of a simple economic structure of just supply and demand.
It is really the supply and demand equation. Yep.
Wow. All right.
So if prices weren't fair, well, then we should all be active investors. And we would see that the active investor who's buying, low and selling high and doing all this stuff would end up with a higher return than buying a highly diversified mix of stocks at some similar level of risk. And as I'm going to show you in a little bit, that is not the case. And that is quite a shocker. 25 years ago, when I started this firm, we just celebrated our 25th anniversary in March of this year. I was just floored to learn this information. Hardly anybody's going to tell you this because they want you to think that somehow they have some superpower to know when 10 million people who have concluded that some price is the fair price, when they're wrong. And it's not plausible even. It doesn't even sound good or sound right when you say it that way. But when you meet somebody and they're in their fancy suit and their fancy tower, you're going, okay, maybe I should, give my money to this individual. He must know something or she must know something that or that the rest of investors don't know. And after 25 years of doing this, I can assure you now I think I can say with 100% certainty that that is not the case. All right. So what are stocks? Okay, well, basically, a stock is that you actually buy an ownership of a business. I mean, I've got this company, IFA, and I could say, hey, I'd like to have some investors today, and you can buy into my company. Well, the next question you want to know is, what's the price? Is that a fair price? And then we negotiate back and forth, and you learn about my company and blah, 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 and you end up with some ownership. And what does that ownership give you? Well, it gives you participation in the growth of my firm, and it might give you some participation in the distribution of profits, otherwise known as dividends. And dividends is a whole nother topic that can be quite confusing for those who are chasing dividends as a source of additional income. I hate to tell you, it's not the case. Every time a mutual fund or a stock issues a dividend, the price of that security drops by the amount of the dividend. So there's a famous paper by Sam Hartzmark called The Dividend Disconnect. And the disconnect is basically that people think they're getting something extra when in fact they're not. And that makes a lot of sense if you think about it. If a company has, I don't know, 100 million in cash and they give it away to all their investors as a distribution of a dividend, the company must be worth less. But more importantly, the securities regulators require that overnight a stock price or a mutual fund price or an ETF price is reduced by the amount of the dividend paid. And so at the end of the day, there is no excess return because a company or a mutual fund is a dividend payer. That's kind of confusing. Go ahead, Richard.
Mark, yeah, I think a nice thing to share too is, so in this example, if Mark's company did go public, then it gets out on the exchange and there millions of shares gets sold out to the public, and there's a huge influx of money that comes into Mark's company. And he gets to utilize that to grow the company. But after that initial first day, there's no more money going into IFA. It's now those shares are out in the public to buy and sell. And so it's that's an important thing to understand too. So it's just that one day of influx of money into the corporation. We call that the IPO. And then after that, there's no more money coming in. So that's
yeah.
Yeah.
I want to make a really important point when you said that, though. A lot of people think of these transactions from the side they're on only. Let's say I did that and I raised $1 million to get cash. Well, to get that million, I have to give up those shares who are now going to earn a return for the people who bought them.
Yep.
That return that I give up, let's say they now get, I don't know, 10% a year for the next 5 years. That's what it costs me to get that million. And if I could get by without having to bring in shareholders, I would do that. And so I think sometimes people think, oh, the company's doing me a favor. They're offering shares to me so I can get this great return. No, it's not true. They're doing it because they have to, really. They need the money, and there must be a cost of those funds. Now, we're going to talk about bonds in a little bit, but in a bond, that cost is a little clearer. I say a little because the price might fluctuate, but over most bond terms, you get your interest rate, which is a known cost, right? You're going to get a bond at, let's say it's a corporate bond. I was to issue a bond instead of a stock, Richard. I might have to pay 15% a year because I'm a small, risky company to those bondholders. And now that's a very clear cost of capital because I have basically this debt. And those bondholders are my debt holders, and I must pay them a return that's commensurate with the risk of them holding this bond. What's the risk? Well, maybe I go out of business in the 10-year period of that bond, and then they get zero. So Michael Milken was very famous for selling high-risk bonds like that, high-yield bonds they called them. And sometimes investors think, oh, great, I get a high yield. No, if you're getting a high yield, that means you're taking a very high risk. And the same concept applies to stocks. Really large, safe companies can get away with offering their investors lower returns, where if we were an emerging market stock, I always like to use the example of a publicly traded dry cleaner in Thailand, and I need cash. I was going to raise cash. What kind of expected return would I have to provide a reasonable expectation for my investors? It's probably in the vicinity of 15%. And when we look at those long-term returns for emerging market small cap companies, that's what they've been. Anyway, individual stocks, there's a lot of ways you can buy them, or stocks. You can buy them individually. I highly would recommend you avoid buying individual stocks. And I can be assured that almost all of you probably have some, but they have enormous amounts of risk, and their expected returns are about the same as the index that they belong to. What I just explained was another Nobel Prize from Harry Markowitz, where he said the only free lunch in investing is diversification. And that basically says I can buy 500 stocks together and reduce the range of outcomes, the volatility, because there's 500 of them, and have the same expected return as buying any one of them within the 500. But when I buy one, my uncertainty goes about 3 times as opposed to buying 500. And so what the free lunch basically is you increase your certainty of getting the return of 500 of them versus buying one. So a little confusing, but
No,
what
I
I
think that's
told you,
very, very important concept there, Mark, because having that one stock, you are riding the highs and the lows, and that could be very extreme and different. And you're trying to mitigate that highs and lows by adding more assets to your asset allocation, by adding more stocks.
that's right. And that leads to the next bullet here, which is mutual funds. That's where they came up with the idea is to pool together a lot of people's money, and so they can buy hundreds of stocks, is typical in a mutual fund. But if you expand that to index funds, the next two, now you're buying thousands of stocks. If you look at the Russell 3000 or the total market Wilshire, it used to be, I think it's still called the 5,000, but there's only about 3,000 stocks left. But now you're in the thousands of stocks as opposed to one stock. And the real sort of cruel trick on investors is the expected return of one stock or 1,000 stocks are pretty much the same, very close to the same. But the uncertainty of getting that return in one stock is roughly 3 times the uncertainty of getting that return when you buy thousands of stocks. Wow. So sorry if that's a little confusing, but this is why people need an advisor, because we spend our life, my wife says I even do this when I'm sleeping, we spend our life trying to figure out ways to explain primarily these statistical concepts to investors. People don't think statistics are important to investors, but what makes statistics important is this fair price issue that keeps things a little more replicable. It allows history to kind of repeat itself because you're resetting the price all the time. Go ahead, Richard, you had a question.
Yeah, real quickly on mutual funds and exchange traded funds. Could you tell us a little bit about the expense of those? Is there a difference usually in the expenses of those two funds?
Yeah, typically the ETFs are at a lower expense ratio. It's because they're easier to operate. And when they first came out, they were based on indexes. And so you didn't have a stock picker or a bond picker managing the mutual fund that probably earns a salary in the $3 to $5 million range. So, and you find the same thing in index funds. Today, a lot of index mutual funds are priced similar to the exchange traded alternatives. Sometimes you'll see a little difference in price, but I think the exchange traded funds are slowly taking over the mutual fund business, primarily because they trade throughout the day. And unfortunately for investors, they make it easy for them to trade large baskets of stock. It's one of the reasons Jack Bogle, the founder of Vanguard, didn't like ETFs and really declined one of the initial offers to create an ETF at Vanguard because he thought that was something that investors shouldn't have, really, this ability to trade all day in their baskets of funds. So among these various types of pooled investments, we have second to the last one here, actively managed mutual funds. And then there are also what are called closed-end funds. So lots of different ways to do that. Now, within stocks, there are what I'll call delineations of the risk of those stocks. And in essence, this is what the firm we like to use, Dimensional Fund Advisors, they call these dimensions of stocks. So there are large companies, and typically they're 10 billion or more in the overall value of the company. Down on the bottom, there are small companies. They're typically up to 2 billion. And I would add on the large company stock, I'm not sure what the average is today. It's probably around 200 million, 200 billion, something like that. Because you've got companies like Apple now that are, I think, over, is it past 3 trillion? I think it's past 3 trillion now. It's crazy how they've gone up recently. So anyway, So the market can be sort of carved up into various groups of stocks. Sometimes I like to refer to them as characteristics of companies. And as it turns out, those help you understand the risks of those firms. And if you remember from Eugene Fama, those risks are the explanation of returns for investors. So understanding bonds, well, bonds are basically a loan you can provide to the government, to a corporation, to local municipalities. And in essence, you're loaning your money, and the return you get, otherwise known as the yield or the dividend on your bond, is tied to the risk of the bond issuer or the entity offering this bond. And you might imagine if it's a US government, primarily because governments have the power to tax, there is a greater chance that you will get your original investment back plus your yield. And so a 30-day, for example, a government bond from the US, a US Treasury note, is considered zero risk. It's sort of the definition of the lowest risk investment. And if you look over 96, 97 years, you will see that that zero risk investment has paid a return that equals almost precisely the inflation over that long period of time. So zero risk means zero return net of inflation. And so I just want you to think of a bond or a fixed income instrument or security as a low risk, lower return investment than your stocks.
Mark, quickly kind of just go over the mechanisms of a bond. So when the company wants to issue a bond, let's just say a corporate bond or a municipal bond, what are they doing there? What's that mechanism they're trying to accomplish?
Well, they go to a brokerage firm, an investment banker, and what they say we need money. I mean, one I always like to think about was Nordstrom's was in trouble during COVID, and they issued bonds. I don't know that they had to, but they elected to issue bonds. And I recall their interest that they had to pay, and that's negotiated, let's say, with Goldman Sachs, who might be issuing this bond, was around 15%. I think I mentioned that relative to me. And it reminds you how risky it was to be in a retail business when your doors are closed because nobody can go in the store. So does that
so
answer your question?
They want to raise money, so they're loaning. You're paying the
They're
company.
borrowing.
Yeah, and then you're expecting a coupon payment.
Yeah.
And that's based on a percentage. And again, there's risk involved, like you mentioned. So the U.S. Treasury is the idea of no risk for the 30-day, but anything past that, you have to start thinking about risk.
And the risk is what we call the risk of default, where they may not be able to pay back. Let's say you pay $1,000 for your bond. When it becomes mature, you want your $1,000 back, right? And in a corporate bond, just think of that Nordstrom for a moment. It's kind of risky. Some retail stores didn't survive COVID. And so they might issue that bond. Then they go out of business and you've lost your entire investment. So there's basically two factors that determine the risk of your bond and therefore the yield. The first one is the term. How long do you have to wait? There's that 30-day treasury, and then there might be a 20-year bond. And the longer you wait, all kinds of things can happen. There's greater uncertainty of getting back your original, let's say, $1,000. And so that's number one is term. The second thing is, in essence, the credit rating or the risk of default of the bond. And so those two characteristics explain virtually all the returns of bonds. And so I'm going to show you a chart later Again, you don't want to buy individual bonds. You want to buy broad, diversified portfolios of bonds so you can minimize that risk even further through diversification.
Real quickly, Mark, back on the different bonds. A couple important notes there on the U.S. Treasury bonds. There is no California state tax on the interest there.
Yeah.
So that's a benefit. Real quickly, Mark, on municipal bonds. Speak a little bit on California municipal bonds. Kind of what's the advantage of a municipal bond?
So I like to say there's none, okay? Because in essence, at the end of the day, your after tax return is just a reflection of the risk. But municipal bonds allow the investors to get them and earn a return, so a California municipal bond, without a tax on the bond. But again, I always want you to think of both sides of this. What is really going on there is the government has allowed them to issue this debt at a lower rate, and that lower rate is they get to do it at a lower rate because you get to get the return with no tax.
Okay.
So it's a little complicated, but I like to just kind of stay at a high level and say there's basically no free lunches out there. You're not. You're also concentrating when you buy these municipal bonds because let's say you buy them for the Los Angeles water department or Los Angeles water area. Well, what happens if we have an earthquake and all those pipes get damaged? I checked one time because I used to own these before I was in this business, and it turned out they didn't have insurance for earthquake damage to the Los Angeles water bonds. So anyway, there's a lot of complication in these. There's a contract basically as a prospectus that includes all kinds of small little details that most people haven't thought about. But when you roll up all of the things that go into any security that you purchase, ultimately the returns you get have some connection to and are some reflection of the risk or the uncertainty of you getting that return.
Excellent. And you also mentioned is there a large basket of bonds? Is there like a mutual fund that is a bond fund or an ETF that is a bond fund? If someone not to get the individual bond, but rather a broad range of different bonds.
Yeah, there are basically index of bond funds. There's a Barclays aggregate index, for example, which includes, I don't know, I'm going to guess 500, 600, maybe 1,000 bonds. You can buy that whole index. It's kind of like the S&P 500 of bonds.
Okay.
And so that's what I'm recommending. And I'm going to show you a slide here in a little bit that shows hardly any managers who are picking and choosing individual bonds do better than that index for the exact same principles that I just explained about stocks.
Excellent. All right. Thank you.
Mm-hmm. So what I've told you over and over and over again is your return is going to be a reflection of the risk you take. So that brings up the all-important question, how much risk should you take? And I just noticed this got 401k in here, so this must have been left over from the 401k presentation. But we do have a survey, we call it. It's not really a quiz. A lot of people think, oh, I have to take a test. It's a survey where we collect what we think are the dimensions of your capacity to hold risk. And in these questionnaires, we're going to ask you about when you need your money. If you see in the right, the first one is time horizon or liquidity needs. We're going to talk about your knowledge about investing. We're going to talk about your net income, your net worth, and basically how much of a loss, and this is more a tolerance type question. How much of a loss do you think you could sit through and not sell some or all of your portfolio? Well, That's a really important question for investors because some people just don't want to see a lot of losses. And typically, the older you get, the less volatility you want to experience in your portfolio. Okay. I wasn't asked to talk about this, but I'm going to spend a little time on it because I do think this might be one of the most important questions for investors. And in fact, when I'm sitting with clients, I like to say, well, the universe of investing out there really starts with this question. Should I go down the path of being active in my investments, or should I go down the path of being passive? So what are the differences? Well, we talked about them multiple times here. The active investor somehow thinks that the prices are not fair or they're not right. And something's undervalued, something's overvalued, which is going to provide you an opportunity, listen to this, to exploit the other side of your trade. I want you to think carefully about that because when you go to buy or sell, somebody has to be on the other side, and you're assuming that you know more than they do. And I would assure you that is a very dangerous point of view. So, this is kind of where you start. And once you pick one of these, your path after that, or your journey after that, becomes very, very different. And after doing this for 25 years and spending probably 2 years before that researching it, I can assure you, you would all be better off to be what we call a passive investor and assume prices are fair and your returns are the result of the risk you took.
And Mark, real quickly, just to give the students an example of an active investor, this would be your mutual fund manager. So there's one person in charge of the mutual fund, and they might have 200 different equities or 200 different stocks in that mutual fund. And he's buying and selling and buying and selling and moving the money around to buy and sell different stocks to add to that mutual fund. That's what we're calling an active investor.
Well, I think even more commonly, it's the representative of a brokerage firm.
Okay.
I every day we get multiple clients that come to us from all these major brokerage firms, and their portfolios are full of individual stocks. So it's not just the mutual fund manager, it's the stock broker. By the way, the reason they call them brokers, when they're done with you, you are broker. It's the broker who thinks they can pick and choose stocks that will allow you to do better. And they don't even think about this, I don't think, do better than some risk appropriate benchmark. So if they're buying a bunch of small stocks for you, we want to compare him to or her to the Russell 2000 small cap index. And if they're buying a bunch of large stocks for you, how about we compare them to the S&P 500 index? And so, and individuals themselves, Richard, people are picking stocks on their own,
right.
In their Schwab account. So basically, anybody who is trying to select investments, stock picking, market timing, manager picking, style picking, those are the 4 different types of active investing that I lay out on my book, and I basically destroy the concept of each one of those step by step.
Okay, very good.
All right, so 5 principles of our IFA model. We've spoken about most of these. Financial markets are efficient. That means the prices are right. Secondly, is that risk and return are inseparable. Those have a positive relationship. I have a client right now who wants to argue with me that low risk means high return. That means great companies have the highest return. That's not the case if you think about the inverse of the return, which is the cost of capital. Companies make themselves great so they can get capital at lower rates. If you look at in the corporate markets, the different rates they must pay on bonds, the bigger, the safer the company, the lower the yield or the lower the interest they have to pay on their bonds. the same thing gets reflected in their price of their stocks and the returns of their stocks. It's just not as clear because of the wide range of outcomes for stocks versus bonds. So diversification is critical and essential. Think of this in if anybody has any statistical background, think of this as getting a large sample size. Sampling is one of the most difficult things for people to understand. You want very large samples of random variables because it helps you better characterize what's going on in those random variables. But if you have small samples, let's just talk about flipping a coin, for example. You might flip the coin 3 or 4 times and get heads every time. You think, oh, okay, that's what I'm going to get from a coin flip. And so a famous, another Nobel laureate who writes books about behavioral finance likes to say that most people make decisions based on the law of small numbers. In other words, some recent event or from some small example of what has happened in the past or what randomly has occurred. They want to extrapolate that to the future. And this is a big, big error for a lot of decisions that just humans make in general. Structure explains performance. Well, structure is another word for a factor or a characteristic of a company, like a small company or a large company. And the last thing is, for all the reasons that I've been explaining to you, you basically need a coach to participate in this crazy, wild capital markets of the world. One of the important phrases is this evidence-based investing. So just as a elaboration of this, I ban the word by my advisors, believe. I don't want anybody saying, I believe this or I believe that. We have data, we have evidence, and we want decisions to be based on evidence and data. So let's look at some evidence here. This is one of my favorite charts that talks about what we call the persistence and outperformance by actively managed funds. So Richard was talking about the mutual fund manager that picks stocks, and probably one of the most common ways we can analyze active investors, because they have a very high standard of reporting their returns, and they have to watch very carefully how they record what they're doing. And so the evidence that we review for these mutual funds is among the most helpful in delineating what you should do with your money. And so look at this. It's just astounding. This is actually a study done by Standard & Poor's Dow Jones Indices. So it's not like we did the study. This is relatively independent. Now, they do have a little conflict in here in that they license their indexes to index funds, but I think it's a very well researched and documented series of studies that you can find over at Standard & Poor's. Anyway, they wanted to know how persistent or how consistent the outperformance of managers were in 2 different periods. We talk a lot about managers getting lucky as opposed to being skillful, and this helps you understand this idea. So these are broken down by these different factors or different asset classes or different characteristics of companies. And so let's just start with one that's most common, and those are large companies. The S&P 500 companies, all the names that we all know, the NVIDIAs, the Microsoft, the Apples, the Teslas, all those big firms, the MAGA 7 today. Anyway, so here we can see if we looked at 938 actively managed funds, and we did this in 2 3-year periods, and this is from 2013 to 2016. In the first 3-year period, and this is the first clue you got a problem, only 10% of those 938 managers ended up beating the index. Now, we probably should just stop there and say, hey, there's not a very good chance you're going to get that. However, just about everybody who picks managers for their clients takes a look at this and says, oh, well, you should invest in one of those winners, okay? Because they have shown some evidence in their mind of skill. Well, let's see what happened, where this little call out box now tracks those 99 winners from the first period into the second period. And hopefully you can all see for yourself, 0 of them continued to be a benchmark beating manager in the second period. And that is as clear as I've seen to explain the luck that was achieved in those first groups of managers, winning managers, and how luck does not persist. And that's why we call this the persistence of, you might call this persistence of luck of active managers, but the industry calls it outperformance. But I can assure you, it's basically just managers getting lucky. They're all just gambling, and sometimes they make big bets on individual stocks. They get lucky because when they bought those stocks, they were fairly priced based on what we know at the time. But companies just maybe keep coming up with surprises. NVIDIA just kept coming up with surprises. Apple keeps coming up with surprises that weren't forecasted and weren't priced into the security before they had some great return. Anyway, when we look at small cap stocks, here's 524 of them. Only 6% beat their benchmark in the first 3 years. So we should just stop there because your probability of doing that is only 6.6%. 6.7%, let's call it. But when we then fast forward, in this case, we did have 4 of those 35 funds continue to win. But now let's think about those 4 out of the original 524 who won over 2 periods. And that is basically a very, very tiny chance. International funds, about half of them beat their benchmark in the first period. This is partly because international indexes are a little harder to capture, all the things that are going on in those international markets. But when we now look at the second period, check this out, 0 continued to perform in the subsequent period after half of them beat their benchmark. Large cap value, 15% beat their benchmark, then 0. Small cap value, 8% beat their benchmark, then 0. Emerging markets, and all the active managers like to say, oh, forget about those large caps, those are efficiently priced, but those small cap and those emerging markets and those international stocks, there's lots of opportunity there because those prices aren't as efficient. They like to say, well, that is nonsense. The big lie, one author liked to call it, because here's these emerging markets, 20% winners go to 0% winners.
So Mark, real quickly so there is a specific benchmark that we are comparing these different categories to, like for small caps, are we using Russell or what?
So this is a Standard & Poor's study. So almost assuredly they're using Standard & Poor's indices.
Okay.
All you have to do is just copy this little link here and go read the whole PDF for yourself.
Okay. Wow, that's amazing.
Now,
so everyone does look back, and when people are looking for mutual fund managers, that I imagine the active investors are looking at their historical, that 1 year when they did great, but that as
3 years. This is 3 years, okay? Yeah. But also, hey, guess what? There's a reason that every prospectus has to say this: past performance is no guarantee of future results.
Exactly.
It's actually 0 guarantee, as you see here. And that is because, please, this is another really important point. When active managers have won, past tense, it was because of luck.
Mm-hmm. Mm-hmm.
Boy, if any active managers are here, they're wanting to kill me right now. Okay.
Yeah, they'd be disagreeing.
Well, all I got to do is show them this. Take a look at that. Are you in there? I'd ask them. Of course, they're probably not. And if someone's picking stocks as a stockbroker, do you think we have this kind of record of their return? Good luck. Your average brokerage statement only covers 1 year.
Yeah.
And they do that for a reason because they don't want you to know this.
Yeah, and they're a mess too. They're about 40 pages long for a 1 month statement. They're terrible.
The
All right,
more confused you are, the better the brokerage firm likes it because they have a business model that is dependent on trading. Okay, so one way to measure luck is to do what's called a statistical significance test on this excess return they earned. And here's another study was done where they used benchmarks of what's called the three-factor model. So you had asked about what benchmark do they use? Well, you can actually blend benchmarks to match what risks the managers took over the whole period of time that you monitor them. This is a 20-year study taking out the element of luck. Out of 150 large blend mutual funds, 0 beat it. Under 107, 0 beat it of large value, large growth, only 0.7, 0 small blend, 0, 1.3. When we look at them all together, only 0.3% had an excess return greater than we would have expected from luck. Now, that's a little complicated study, but if you don't get it, you should pay somebody who does. Otherwise, you're going to be paying a lot of money to people to gamble with your money and almost assuredly end up with a worse result. So this does not have the luck taken out of it. And this is another study done by Standard & Poor's that looks at just managers over 20 years. And here we see that 96.83% underperformed their benchmarks just looking at all of these various asset classes combined. Basically, if you see more orange among these pie charts, that means managers did not beat their benchmarks. Do you get it now? Here's international, a lot of orange. That means it's really bad for the active manager. Buy the index. We talked about fixed income and those bonds, right? So you can buy individual bonds. You can pay a manager to buy individual bonds. Well, you see a lot more orange than you do green here. And the orange means they underperformed a diversified risk-appropriate classification index. And so, for example, general government bonds, 90% did worse. Government intermediate bonds, 100% did worse. So I don't know what this general bond funds, 64%, but basically it's a really bad probability bet for you to try to go to the active route. Now, one of the reasons these managers do so poorly is they're chasing past returns. And we see that in evidence of what we call a style drift. So a style is, you should think of it as an index. And what we see among all US equity funds, 54% of them changed their asset class target, if you will. Let's say you have a large value fund. They changed along the way and bought some large growth stocks or some small value or some small growth. They mixed it up trying to beat their benchmark. Now you think about it, that's cheating. So because they're buying some other asset class that they're not supposed to, according to their fund objectives, although every prospectus gives them huge leeway to do this. Anyway, 54% bought something other than what you were hoping to get in your mutual fund. Another reason to use an index fund, because an index fund is pure to the asset class or to the index. All right. How are we doing on time?
We've got 15 minutes, but we want to leave maybe a few minutes at the end if there's any questions.
Sure. Here's another quick element of luck. We kind of saw this in this other chart, but this is at a sort of a different level. This is for institutional accounts. So what's an institutional account? I would say it's somebody with, I don't know, typically $100 million. So it's an endowment, a big pooled a retirement fund, maybe. Those are mostly gone. But for municipalities or for teachers, there's a whole bunch of other big pooled institutional accounts. And in that world, there are consultants, basically an advisor like us. We do this as well, where their primary job is to find managers who will have consistent performance. Remember that chart I showed you where they did really good in the first 3 years and the next 3 years they did badly? Well, this looked at 8,755 decisions to hire a manager. And look at this incredible result here. The line in the middle was the point that they hired somebody. So for the previous 3 years, those managers that were hired had outperformed their benchmarks by almost 3% a year. Remember, I told you they picked those winners from that previous study, and then going forward, they don't win anymore. Well, look what happened. After those 8,755 hiring decisions of investment managers, on average, over the next 3 years, they underperformed their benchmark by about 0.5% a year. If that's not damning, I don't know what is.
They're rethinking their decision by hiring them, I bet.
So I heard one of the professors, Sunil Wahal, present this study at a dimensional conference. And when he was introduced, the guy said, I think Sunil should get a remote starter for his vehicle, because when the active investment world sees this study, they're going to want to kill him. As a subset in his study, he looked at the whole, let's see, what did they call this? The round trip, that was the word I was looking for. The round trip decision of not only firing a manager, but now hiring a new manager, right?
Okay.
So I'm going to fire somebody. Richard did really bad. All of a sudden, I'm going to get rid of him. And Mark did really good, so we're going to hire him. So they track what happens to both sides.
Okay.
And the punchline here is the managers they fired actually did a little better than the managers they hired. So that's sort of salt in the wound. Is you would probably have been better to stick with the first guy. However, the best decision is not to play this game at all and just buy the benchmark, basically.
Okay. All right.
Market timing. People see, bad news comes along in the market. I'm going to sell. I'm going to wait for things to get better. I'm going to get back in. It's very, very dangerous. It's the same issue with buying individual stocks, by the way, that basically you may have heard the phrase that it's the time in the market rather than the timing of the market that's important here. So basically what this is telling you is if you invested $1,000 in an S&P 500 index fund over 20 years and you just bought and held it the whole time, your $1,000 at the end of the period was worth $6,347. But let's say you started gambling on your days and missed the 5 best days over 20 years, your gain drops down to $4,000. And let's just go to the end here. If you missed the 40 best days, your $1,000 actually became $791. You actually lost money. And if you think about it, that's a very small percentage. How many days are there in 20 years? I think it's 5,000 some days. So anyway, you can't time the market. You don't know what tomorrow is going to do. Remember, it's a coin flip from day to day because the prices are fair. So people are basically guessing what the coin flip's going to be. Now everybody asks me, well, what about Warren Buffett? Warren Buffett's made money. He's been a great stock picker over his lifetime. Well, I'm going to pop that bubble for you as well. Morningstar has 43 years of data of the Berkshire Hathaway stock. and we're going to benchmark it to a Russell 1000 value. But remember about the style drifting, investment managers, including Warren Buffett, style drift all along the way. And so that's probably not the ultimate analysis of his return. But if I look the whole period, right top middle here, his average excess return was 8.6%. And the standard deviation or the variation of that return, it's kind of you got to dig into the calculation a little bit, but was fairly high at 20. Now let's just do something interesting. Let's divide that whole period into two different periods to see if there was persistence in performance from one period to the next. This first half of Warren Buffett's career is what made him famous. Look here, he was beating his benchmark by 16.8% per year for a whole 22 years. And so people see that these green bars means that he had a return greater than his benchmark. And in fact, in 1985, he was 62% over his benchmark. Well, given the unlikeliness of people to beat their benchmarks that I've shown you, I can assure you that that was a very highly concentrated bet, probably Geico was in there, and it probably wasn't the right benchmark for him. But nonetheless, let's say you saw this and you decided, man, I better put money into that because it's had such a great return. And let's see how that worked out for you in the second period. Now you see his average excess return over his benchmark for the second half of his career was only 0.15%. And you can see in the first 3 years, he underperformed his benchmark, then he outperformed it, then he underperformed it, and he outperformed it. You're back to basically doing coin flipping from one period to the next. And so I don't want to hear anybody ask questions, well, what about Warren Buffett? Because Warren Buffett's excess return basically has gone away.
All right.
Let me just do this real quick. This is a nice little chart, Nobel Prize winning chart again, this time for Harry Markowitz for a paper he wrote in 1952, which was the year of my birth, and why it's my destiny to bring this to you. So this gives you a nice little relationship here between risk and return. Remember, this only is important if prices are fair all the time. If prices aren't fair, all bets are off on risk and return. That's why people are active managers. They don't care about the risk. They're just gambling, thinking things are mispriced. But now you see this nice, neat line here that if I'm in a 1-year bond fund way down here, my risk is only 2 and my return has been only 5. But if I'm up here in those emerging market small cap companies, that publicly traded dry cleaner in Thailand, hey, look at that. Their cost to capital and the return earned by investors was about 15% per year, the number I mentioned to you a couple times for very high risk investments. Here's a bunch of individual stocks. Look at on average that survived over 48 years. Only 146 of them survived, by the way. Look at the average risk is about 30. If I go over here, it's right under this 90, is the S&P 500. It's right in the middle of all those, but at a risk of only 15, and you can see earned a return that was kind of the average of all those individual stocks. The S&P is by far the better investment as opposed to buying those individual stocks. Okay, so what's really important? Well, I've mentioned over and over, you should look at indexes. This is maybe one of the more powerful charts in trying to decide what indexes you should invest in. And it shows you the 3 main characteristics over the 3 main regions around the world and the differences in returns among small cap and large cap, among value stocks and growth stocks, and among a new factor called profitability, high profitability versus low profitability. And this is what we use to decide what allocation of benchmarks. These are all benchmarks. An index is a benchmark. What allocation of benchmarks I would like to use to design a portfolio. And when you finish that allocation, you can't just benchmark that whole portfolio to one of these indexes. I got a question last night. Can you compare my blend of indexes to the S&P 500? Well, that's a really bad comparison, and you can see right here why that might be the case. All right, Vanguard versus dimensional. Well, a lot of people like to say, well, good, you told me I'm going to go buy index funds. I'm going to go to the largest or one of the largest providers of index funds. BlackRock and Vanguard are the two big ones. And I'm going to buy a small value index at Vanguard. Well, not all indexes are the same. And I'm just going to show you two little numbers to contrast that. Two small value indexes, the burgundy's Vanguard, the blue is dimensional, but small at dimensional is an average company of 3.4 billion, while small at Vanguard is an average company size of 6.6 billion, double the size. And you see here, because it's smaller, the companies have higher costs of capital. The return demanded by investors to hold those securities has been higher, so it's 10.5% versus 9.9. However, those two returns don't show up all the time. Different probabilities of getting those excess returns depending on how long you hold the investment, and that's the same all over the world. And
awesome. All right,
I'm going to be done.
Time, and I've got one question for you.
Good.
So back on the slide with the Berkshire Hathaway with Warren Buffett, it says your statistics on Berkshire Hathaway are inaccurate because you started with 1981 rather than 1965. Please.
So those numbers, this is the data that we can get from Morningstar. It's the only accurate, only data that we are confident in using. And if Morningstar, I think, was comfortable in going back further than that, I think they would.
All right.
But nonetheless, in the last 20 years, he hasn't been able to do it. So maybe that's a good reason why Warren Buffett told his heirs and would tell most investors today to just put their money in the S&P 500 index.
Fantastic. Well, thank you, Mark. And Eugene, do we have any other questions?
I don't see any. Yeah, it's been pretty quiet out there other than the question you just covered.
All right. Well, excellent. Well, Mark, thank you very much for a great presentation and a good understanding of the markets out there. And to the students, we thank you for your participation, and we'll be back next week at the same time to discuss our final session of financial planning number 2.
Okay. Thank you, Richard. And thank you, everybody, for your time today and listening. Hope it wasn't too confusing. If you have questions, feel free to give me a call or to call Neil, probably best. And Neil can set up a time when we can all get together.
Fantastic. Thank you.
All right. Have a great day. Bye.
See ya.